We love getting questions from you. Today's has come in anonymously, but if you would like to ask a question just like today's listener has, please head to equitymates.com/contact and leave us a speak pipe. But Ren, what have we got today?
Hey guys, currently I've got a large majority of my portfolio in a single Aussie mining stock, and I want to look to rebalance that to get into a diverse growth core. Talking a lot about dollar cost averaging on buying in. I keen to hear your thoughts on this with selling down and restructuring when it's a large weighting of a portfolio. I've been sort of tossing around DCAing the sale and then buying into ETFs and selling good chunks to capture more time in the market alternatively. Perhaps a hybrid of the both, various large volumes and DCAing some remainder. ChatGPT thought 50 to 60 sell and then DCA the rest. Anyway, keen to hear your thoughts. Cheers.
Well, thank you for the question, and a reminder that if you do want to ask your question, you can ask it anonymously like this person. But Bryce, knowing when to sell, it's one of the harder parts of investing.
We should firstly start by acknowledging that this listener has recognised that there's a bit of concentration risk going on in the portfolio and that probably diversifying is a good thing. I think having a large amount or just a one stock portfolio for the long term can leave you very exposed to the fluctuations for that one particular stock. So knowing that you want to start diversifying, I think is a good place to start.
Okay, interesting. So you read this question or listened to this question as if they had just put all their money in one mining stock. I listened to it as if they had had a massive win.
Okay.
Like that they'd bought a stock and it had 10 bags and now it was a big portion of their portfolio. So I choose to live in that world where the listener has just had a big win and wants to know what to do with it.
Yeah, I mean, congratulations.
So I think probably for us, there's 3 steps. They're general, but unfortunately, there are some nuances and some specifics around like what the company is. Do you still believe in the company?
Yes, yeah.
How much risk is inherent in like the company's valuation at this moment?
Yeah.
What are your financial goals and your risk tolerance? And like these are all things that we don't know. So it will need to be general, but I think hopefully it will help you think about how you approach the question of when to sell and how much to sell.
Yeah, let's assume this listener is ready to rock and roll and sell, which it sounds like they are.
Yeah. But I mean, like, for example, we can bring this forward. For example, it's not just are you ready to sell, but it's like, are you optimized for tax?
Yes.
If you haven't waited the 12 months to get the capital gains discount, I would suggest, especially if you've 10 bags of stock, it's probably worth waiting.
For sure.
Yeah. It's not just about do you feel ready, it's about like have you optimized the timing.
Yeah.
Also, like what's your tax position in this tax year? Is this the right time to sell or is it best to wait for another year?
Yeah.
Anyway, all of that stuff.
Yeah.
It's mainly about tax.
It is always tax.
So tax consideration, we've talked about tick. All right. So I reckon there's probably a 3-step process that we go through. And the first one is actually start at the end. So start at the end goal in terms of what you want your portfolio to look like once you've done the rebalancing.
Yeah. I think that's anything from, do I want my portfolio to be one of the all-in-one ETFs? Do I want it to be a mix of core index ETFs that you're managing the weighting? Or is it going to be a portfolio of a bunch of individual stocks?
Yeah.
I think all things that you need to be pretty clear on before selling and just starting to throw the cash into the market for the sake of it.
And specifically here, it's knowing what weighting you want an individual stock to be in that end portfolio, because that should dictate how much you sell. Like if you say I want each individual stock holding to be no more than 10% of my portfolio, then you should be like, all right, well, I'm going to sell the amount that gets me to that weighting.
Pretty easy.
No half steps, just like
do what needs to be done.
Yeah. If you feel like that's selling too much and taking too much potential upside off the table, then you need to reconsider the rules that you've set for yourself because you're not comfortable with them. Or you need to reconsider, I guess,
why you're selling,
your risk tolerance or something, and maybe you need to say, oh, I'm actually willing to take more risk because I don't feel comfortable selling this much. But like have a plan, have some rules, and then sell to what gets you within those rules.
Yeah.
So that's step 1 and step 2.
Well, the only step remaining is step 3, and that's to reinvest it immediately into the portfolio.
So interesting you say reinvest it immediately because the questioner was talking about wanting to dollar cost average in. So why are you saying reinvest immediately rather than DCA?
I think for me, like, let's just take a situation. Let's say it's 50 grand we're talking about. You've already got 50 grand in the market working for you. I think to take that out and then DCA that into probably a more diversified, I'm assuming, portfolio, like you're already...
Well, it will be more diversified because it would be impossible for it to be less diversified.
Exactly. So you're already kind of reducing the risk. And so then having money not invested in the market and sitting there DCAing, you're kind of just losing time in the market. It's like you've already been comfortable with the fact you had 50 grand in. So you may as well just get that 50 grand in as fast as possible.
Yeah.
That's my view. There might be other ways that you could do it. And what DCAing, I mean, is an alternative. I think the stats also show though, Ren, and we've done this on the show at some point, that if you do have a lump sum, it's actually better just to get it in.
Yeah.
So as long as you know what you're going to buy, what weightings you need, I'd just be deploying that straight away.
Yeah. DCAing is super powerful. Don't get us wrong. But the most powerful way to do it is put your money to work as soon as possible and then continue to DCA with money you're getting
cash
from
flow.
Your job, or like, dividends paid on investments or whatever it is, like wherever you're getting cash flow, putting that money back to work. Unless you have like a low risk tolerance and you're not comfortable putting all that money to work at one time. But we're assuming, given you have so much money tied up in an individual stock, you have the risk tolerance to put that money to work in the market.
Yeah.
So just put it to work.
Just get it in there.
Yeah. So 3 steps. Start with the end goal. What do you want your portfolio to look like? Sell down your positions so that the big meaty positions then fit those rules, and then take the money, the cash that you freed up, and reinvest it to reflect what you want the portfolio to look like.
Yeah.
The right weighting between core and satellite. In your satellite, the right weightings for individual stock, like if it's 5% per stock, 10% per stock, whatever you want. And then in that core, making sure you've got, good, low cost, globally diversified index tracking ETFs is how we would go. But whatever it is, just like a really solid idea on what you want your core to be.
Yeah.
And then just keep dollar cost averaging in.
And then try and find the next 10 bagger.
Yeah.
It's easy as that. Love it. Well, thank you so much for the question. There'll be a link in the show notes or description below if you would like to ask one yourself. But Ren, that brings us to the end of today's episode. Always great to chat stocks. If you could leave us a rating and a review on your podcast app, or like the video and leave us a comment below if you're watching us on YouTube, that would be really appreciated. As I said, always good to chat, and we'll pick it up next episode.
Sounds good.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.